Bloomberg Audio Studios.
Podcasts, radio, news.
Turning now to the Fed. Former New York Fed President Bill Dudley writing in his latest Bloomberg Opinion piece, the U.S. Federal Reserve and its chair, Jerome Powell, are rightly choosing not to act on any assumptions about what Donald Trump might do as president. That said, if he follows through on his more extreme campaign promises, they'll struggle to contain the economic consequences, a problem that equity investors ignore at their peril. Bill joins us now. Bill, you've been in the room. You understand what this is like. Give us a sense potentially of this tension that might brew between the Fed chair and President-elect Trump.
Well, in the short run, there's not going to be much tension because I think the Federal Reserve is still going to cut interest rates a bit further. But longer term, if you look at what President-elect Trump is proposing, higher tariffs, deportations, and fiscal stimulus, that's going to tend to boost inflation, disrupt economic growth because tariffs will force people to reorient their supply chains. And it's going to make the economic environment more difficult. And so the Federal Reserve ultimately is going to react to that. But as Powell said in his press conference last week, we don't assume, we don't guess, we don't speculate. So they're not going to act until they actually see the Trump agenda actually take form. So don't expect any near-term response from the Fed. But in the longer term, I think if Trump does what he said he's going to do, it's going to be a difficult economic ride.
Well, Bill, as you point out, though, if Trump does anything big or abrupt, in your words, the central bank's response will occur too late to mitigate fully the economic impact. So what is the needle to thread to not respond too soon when we don't know the extent of things, but also not waiting too late that you just can't do anything at that moment?
Well, I do think there's a risk that if Trump isn't very aggressive in terms of his policy choices, that the Federal Reserve will be late. They'll be waiting to see what happens. And then when it does happen, it'll be bigger than expected, and it'll have bigger consequences for growth and inflation. At that point, I think the Federal Reserve would be a little bit behind the curve, and they might have to actually catch up. But that's not a near-term story. That's probably, late 2025, first half of 2026, just at the time that Powell's wrapping up his term as chair.
Good morning to you, Bill. In your opinion piece this morning, you talk about an oddly divergent reaction from the bond market and the equity market. I want to focus on the bond market because it has been a wild ride. And this morning we waking up, again, the birds have been reawakened. The question I would put to you is this. We don't know the tariff, we don't know the tax, we don't know anything about the fiscal policy exactly. We've some broad parameters. When you look at the term premium in the bond market, the debate is how much more term premium there needs to be if there's going to be such a large deficit run. Some of the numbers thrown out there are pretty obscure. But are we on the brink of where there needs to be a lot more term premium to hold U.S. Treasuries?
Well, I think that there needs to be some more term premium to reflect the uncertainty about the economic outlook and the unsustainable fiscal path of the United States. That's one area where Powell actually did speak out last week. He did say that the fiscal path of the United States is unsustainable. And if President-elect Trump does all of the things he wants to do in terms of corporate tax reduction, extending the 2017 tax cuts, the fiscal situation is going to worsen, not improve going forward. So I think the path to higher bond yields is the most likely path. The other thing that's happened, of course, is people have changed their expectations of where the Fed's going in terms of short-term interest rates. A couple months ago, people were expecting the federal funds rate to bottom below 3%. Now the markets are expecting the federal funds rate to bottom at around 3.75%. So if you have a higher federal funds rate, then you're going to have a higher bond yield just by construction.
So the direction of travel, you say, is higher in yields. When you look at the response from Powell at that news conference, and we've touched on this with various people, are we going to hear much more, I don't know what the right word is, aggressive, demonstrative, exacting language from the Fed? What word would you choose that the Fed's rhetoric needs to become more emboldened in 2025?
I think the Fed is actually going to be very, mild in terms of their language. They're going to set monetary policy based on what they think is appropriate given the growth and inflation outlook. And as you noted, it's going to take time for that to manifest itself because we don't really know exactly what President-elect Trump is going to do. So I think the language will be actually not combative at all. You saw last week, reporters asked Powell about, how he can react to the Trump policy mix, and Powell basically said no comment. So I think in the very short term, the Fed's going to keep its head down and conduct policy based on how the economy is doing right now.
But if we can take a step back to the reaction that we've seen here in the now, as you write in your column, you find the stock market response baffling. Equity bulls have been really excited about the prospects of tax cuts and deregulation. What are they missing?
Well, I think that the stock market has this notion that we're going to have deregulation, we're going to have corporate tax cuts, and that's going to boost corporate profit margins. And I think that's probably a fair part of the argument. But I think what they're missing is all the consequences of the other parts of the Trump agenda. Higher tariffs mean higher inflation. They mean disruption, lower productivity growth. Deportations affect the supply of labor. And unsustainable fiscal path means higher interest rates. When I look at the bond market versus the stock market, I think the bond market, as bond yields rise, that's going to put increasing pressure on the stock market. We're starting from a point that the stock market valuations are already extremely high. So if bond yields go up, I think that will weigh on the stock market. I would not be a big stock market bull at this point.
Bill, given that backdrop, how difficult is this December meeting going to be for the Fed?
I don't think it's going to be that difficult because I think Powell laid it out pretty clearly last week. They think that the economy is, the risks of inflation and the labor market are roughly in balance. They think monetary policy is still restrictive, so that they're heading back towards neutral slowly. So I think a 25 basis point rate cut in December is still the most likely case. Now, if the economy continues to stay stronger than expected and inflation stays stickier than expected, then that December rate cut might be the last rate cut for a while, but that really depends on the data. The Fed right now is really data dependent in terms of where they're going. The direction of rates is downward, but slowly because the economy is continuing to perform pretty well on the growth side.
Last week, Powell was asked a number of times by journalists about what would happen if President-elect Donald Trump tried to remove him. And this morning in the Wall Street Journal, they talked about 2018. And Powell then went with their reporting to Treasury Secretary Steven Mnuchin and said that he would fight his removal if sought by the president. Are you concerned about the independence of this Fed?
Well, I think you have to always be concerned about the independence of the Fed when you have a president that seems to be, a president-elect that seems to be hostile to the Fed's independence. And, the reason why we want an independent central bank is because historically, independent central banks actually do a better job in terms of managing monetary policy to achieve the outcomes that we want in terms of growth and inflation. So independence is really driven by the fact that you actually get better outcomes. If people think that the Federal Reserve is going to change course based on pressure from the president, that increases uncertainty and risk. And it also makes the Fed very short-sighted in terms of its policy agenda. So I think the Fed, basically the Fed's going to try to maintain its independence. Powell, I think, was very, very clear last week when asked about whether he's planning to resign early. No. Whether Trump has the right to fire him legally. No. So Powell basically said pretty clearly, I'm going to finish out my term, which ends in May 2026. And so tried to close off the debate on that whole issue.
Not permitted under the law. He kept saying that. No, no, no. And the Wall Street Journal gives some insight into he knows this because he went through it in 2018. Former New York Fed President Bill Dudley, thank you so much for your time and insight this morning.